welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with Jim Riggio and Paul Demers. Before we get started, a quick disclaimer: the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. If you don't know your situation and have no way of knowing what level of risk is appropriate for you, we're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And just a reminder, this is for educational purposes only. So, Jim, Paul, welcome. Nice to have you here. And I guess we're talking about hedging today.
Yeah, 53 seconds. I think we're going to have to start competition to see who can get through that the quickest. Okay.
I can do it faster.
that was the first one. Yeah, we wanted to end up talking a little bit about hedging. You know, it's something that Paul and I had spent a lot of time on when we were working together. And, you know, it really comes down to a couple of questions. The first one is, you know, what are you trying to hedge? What's the position that you're trying to hedge? You know, you're going to end up hedging a Kevlar different than you would end up hedging the S&P 500, different from a mixed portfolio, different from a road trip trade. What's my option? What am I trying to hedge? The second one is what are your potential losses that you're trying to end up hedging against? Am I looking for, you know, just some protection? You know, this is when I ask these questions to some people, okay, who aren't options traders, and even sometimes when they're options traders, what I find is people have like unbelievably, they have fantasies. I don't want to lose any money, and I want to keep 100% of my gains. For those people who feel that way, this is a picture of Fantasyland, and there's the Google directions to get there, okay, because it doesn't exist, okay. You have to end up thinking it more like insurance. There was a really good article. If you go to the home page of Capital Discussions, not the home page of the member site, but of the public site, we ended up having an article written by Joanna White a couple of weeks ago, you know, talking about how insurance products were like options. Okay, I'd really suggest that you end up reading it. Here's the URL. If you don't want to follow the URL, just go to the public, you know, don't sign in. Go to the public's website for Capital Discussions, and it's one of the articles on the bottom. Okay, and there's the URL if you do want to end up getting into it. But when you think about what you're trying to hedge, you know, the insurance questions are, well, what asset am I trying to insure? Am I trying to insure my house, my car, my health, my life? What am I trying to end up insuring? The next question that people end up always asking is, well, what's the deductible? Okay, and you have to end up thinking about that. Same thing with your position. Do you need to really protect against a 2% drawdown in the S&P? Are your positions that sensitive? Like with insurance, you know, the tighter you want to make that deductible, okay, the more expensive it's going to become. Also, what's the maximum payout you end up having? You know, if you have you know, in your car insurance, a great example, you know, do you want to end up being protected for only $100,000 or $300,000? You know, how much do I want to protect the entire value of my car? Do I want to protect or my house? Do I want to protect the entire value of my portfolio? You know, do I need to only protect it maybe to a 50% drawdown because I don't think it's going to go further down than it? So you kind of have to end up thinking about what you're actually insuring. You know, obviously duration is important. How long are we end up doing? Do you want to end up getting through just the election, or do you want to get through the next two Fed meetings, okay, and the election, or do you want to end up going over the next 6 months? So you kind of have to think all of these things through when you're putting your hedge in. And then the last couple things are, you know, how much does it cost? Okay, and if it costs too much, can I end up selling some of my excess insurance to somebody else? Like, for example, for those of you that have life insurance policies, you can actually go there are a number of websites, a number of companies, some of them even legitimate, that will end up buying, okay, your insurance policy from you. What they'll end up doing is that they'll take a look and see, and it's all just math to them. Okay, you know, you're 85 years old and you have a policy, okay, that they're thinking, okay, here's your average life expectancy. How much will they end up paying for it? What's the, you know, the capital value of the insurance policy? And they'll make you an offer for it. Okay, well, the same thing with us, right? Do we have so much insurance that, you know, we bought a long-term put, but can we sell maybe a short-term put against it, or a portion of a short-term put against it? Because we don't need the entire amount. So when you're going through these things, the logic that your brain goes through when you're choosing your insurance is pretty much the same type of logic that you go through when you're looking to end up hedging. Okay, so if I ask the questions again, okay, let's try that again. What's my potential losses that I'm trying to hedge against? Am I trying to protect for any loss after the first 10% drop in the SPX, okay, for the next 6 months? Do I need to only protect, say, maybe half of the first 10% drop, and then 75% of my losses after that, right? What am I trying to end up doing? What duration am I going through? I gave you the example of the elections and the Fed meetings. Am I trying to end up hedging against what asset? Am I trying to hedge my portfolio, which is almost a mirror image of the S&P 500, and I got a beta of 0.99 to the SPY? Pretty easy for me to end up hedging in the SPX then to build my hedges. Am I trying to end up hedging against a broken wing? Am I trying to a butterfly? Am I trying to end up hedging against a butterfly with a long call? I'm going to see my best friend from college who's been at AT&T basically since we've graduated from college. What does he consider hedging? How do I end up hedging my AT&T employee stock options? Because that's where most of his net worth is. One of the things that Paul and I put this in here, and I've been asked this a couple of times to explain, why I talk about gamma more than delta. Am I trying to protect against price movements? Okay. Now, if I am a Delta 1 investor, right? A Delta 1 investor, by the way, is just somebody who buys the underlying, right? If I end up buying the SPY, I have a delta of 1, right? If it goes up $1, nothing's changed. I'm still a Delta 1. If it goes up another $1, if it goes up another $100, I'm still a Delta 1. If it goes down $1, it goes down $2, it goes down $100, I'm still a Delta 1 investor, right? Dollar for dollar investor. But usually what we do, we're not. There's some curvature to that straight line, okay? The guys who trade derivatives on fixed income products, they would call that convexity, right? A negatively convexed, P&L curve would be a negative gamma curve. And so a negative gamma curve, we would sometimes call that a frown. So the P&L would end up losing money, okay, if you went to the right or to the left. The reason why I don't think delta is nearly as important as gamma is because delta is a snapshot in time of where my deltas are right now. I care a lot more about where my deltas are going to be, and if we end up moving left or right, that's what we're really hedging against. We're not hedging against a $1 move in the SPX. We need to hedge against a $50 or a $100 or $200 move in the SPX. Right? So how quickly will we end up having risk on that? A lot of people end up taking a look in the classic negative gamma, negative vega trade is selling a strangle or a straddle at the money. You're collecting a ton of theta, okay? But what happens if it ends up moving pretty dramatically? I've talked about, and Paul has seen this, okay? Every butt kicking I've ever received from the market, okay, the two thugs that beat me up were these two guys, right, Gamma and Vega. So how do I end up protecting against them, but only protecting against them when I need it? I don't want to end up buying like extra insurance if I don't end up needing it. I just need to end up making sure that I'm protecting the right place. So you can see that the question is pretty complicated, right? It's not a simple, well, how do I end up not losing money because I bought the S&P. If you bought the S&P, right, if you bought the Russell or the S&P, or you bought an ETF, easy to hedge against that one item. Also easy to end up choosing those insurance questions. You end up putting on something and it has more of a, not a straight line, okay, T plus 0 line, but, for those of you guys who did derivatives and calculus, okay, we're looking at, probably a multivariable quadratic type of formula. Which, as you guys know, is not an easy thing to end up doing. And so now you also have human factors on what happens with fear. Are people just trying to protect against if the market goes down a little bit? Are they trying to is the market trying to end up protecting if it melts down further from where we are? So there's a ton of variables in here that make this a pretty complicated question. So what I ended up thinking is that Paul and I talked about this, we've talked about it for years, but we were talking again this morning about what we ended up talking, and we thought that the best thing would end up doing would be to go through some examples. Okay, Paul and I went through a ton of different examples, and so Tom, if you're the host, if you could give the ball over to Paul, and Paul, as you're taking the ball, do you want to end up just talking a little bit about the conversation we have and kind of set up the hedge or the trade that you're going to end up showing now?
Sure. Excuse me. You'll give me just a second here to get a little more prepared.
It's the Jeep, right?
Yeah, I did the Jeep during.
I'll tell you what, you set up, and I'll kind of just I'll kind of do the setup a little bit for you, and you can pick it up once you have everything set up on your screen. Paul and I were trading during 2011 together, and we had the Jeep on. Now, the Jeep is, some people ended up having a different version of it called a Weird Or. But the reason why we called it a Jeep was that the P&L curve expiration looked exactly like my Jeep Wrangler. And so it was very easy for us to end up talking as the market would go up and saying, we're halfway up on the hood, okay, of the Jeep, and we would know exactly where we were, and it became it was a bit of a joke in the beginning, but we found it was very, very easy to discuss, our hedging techniques and where we were. The biggest risk that we ended up facing is that if we moved onto the roof of the Jeep and then to the back end of the roof of the Jeep, like in the back seat, we were getting hurt by deltas were already bad. They were getting worse, okay? By getting worse, okay, and this is what I mean by gamma risk. If you are negative gamma, well, let's start with delta for just a second. If you are negative delta, you want the market to go down, okay? If you're positive delta, you want the market to go up, right? It is a directional play. Gamma is not a directional play. It says, are things going to get better for you or worse for you as the market moves? I didn't hit mute, did I, guys? You can still hear me?
Yes.
Okay.
Yeah, we can hear you.
Okay, good. And so are things getting better or worse for you? When you are short gamma, and most of us, or most of you, okay, because I'm a fanatic about this, are going to end up being premium collectors, meaning we're going to collect theta, and the price that you've paid for that, you've always heard, okay, in all the educational stuff. Well, if I'm going to collect theta, and the example to do is sell a strangle, a straddle at the money, I'm going to end up collecting my premium. Each day I'm going to end up making my theta, and the price that I pay for that is a negative gamma, meaning if nothing happens, I make money. So when you're a negative gamma trader, you want the market to just sit there and not move. If you're a positive gamma trader, you want the market to move. Now, that's a simplified version of a strangle or a straddle. Once you start putting in these 3, 4, 5, 6 strike positions, no longer is it just a simple curve that keeps going in one direction. It's almost like if you ended up taking a second or third, derivative. If you remember back in school, if you guys did a lot of math, it was doing quadratic formulas. Okay, not to the second power, but to a fourth or a sixth power. And so what ends up happening is that it no longer just has one bend in it. It can have multiple bends in the curve. It can start to end up going up. And so what happens is that your deltas and your gammas, all of your Greeks, they change. They change with time. They change with price. They change with volatility, right? Those are the three variables that are going to end up affecting things. So what we need to end up doing is that Paul and I know, and there's the shape of our Jeep, as you move down in the Jeep, I know that the rate of descent, if you take a look at the slope of the line going to the left, if we start to move a little bit down, it's going to start to get steeper and steeper and steeper until it feels like we're almost falling, off of a cliff there. What makes this even worse is that as we go down, usually volatility goes up. This is also a short Vega trade and gets shorter Vega as we move down. So now I got a double whammy to end up protecting against. So we thought that the Jeep in a really hard move down would be a non-trivial example that we could talk about how to end up hedging. Paul, anything else about the setup about trading the Jeep through 2011? Okay, that was the nightmare that it was.
Most of it was emotional, actually. the trade ended up okay, even without the insurance on it. But I just wanted to show, because we were, I had to mute myself. I had a phone call, so I missed some of what you were discussing earlier. But we ran this with hedges on them all the time, because this, especially for me, I'm showing you a one lot, one tranche of a Jeep, and at the time, I was running 8 to 10 of these at a time, so I always had them hedged. So I can. I mean, it's either I can run through. What do you want me to do, Jim? I show the adjustments that were done along the way with the Jeep, or we can just go to the end where we can show what the hedges did.
What I'd like to end up doing is, because the shape of this curve, okay, is not dissimilar to what a lot of people trade, in the sense that Amy's Weirdor has a similar type. I know the rules are going to be a little bit different, but I was asked, okay, earlier this week, okay, what gives an options trade edge at the setup? And the answer is quite simple. When you think about it at a very high level, you have to end up selling more volatility at a higher level and buying volatility at a lower level, right? Here's what it comes down to, right? Buy low, sell high. I mean, it's as simple as that, okay, if you want to end up getting right down to it. But here's what that ends up meaning in practicality. Those short options at the top of the windshield or at the top of the back of the roof, you see how I mean, right, when I talk about that, you guys look at the Jeep and say, okay, I know exactly where it is. Those have greater value to them. And so if you think about what I said, sell low, okay, you want to be able to end up, selling high and buying something low. If I was to sell the implied volatility only, and that's how I valued what I was selling, the answer is I want to end up selling a put, 500 points below the money, because it's going to have a super high volatility. The at-the-money volatility might be 12. You go 500 points below the money, okay, 3 months out, and you're going to have, 60 vol. Okay, it's going to be so much higher. The problem is that we're going to get a nickel for it, or a dime. We're not going to get any money for it at all. So say, okay, let's go back to the drawing board. The second one you end up saying is that, well, I want to get as much money as possible for selling it. Well, then you're going to be selling puts at the money. The problem with that is that if it moves down, the curve going to the left, as on the Jeep, is much worse. I mean, it's just, and it doesn't have any bottom. It just keeps getting worse and worse. You get killed with, as soon as you start to move. Vega moves against you, which means that your delta is going to get worse and worse as you move down. Vega is against you, so its implied volatility is going to go, the Vega monster is going to have his hand in your pocket, taking your money away from you. So you have all of these types of issues. So Paul, I do want to go through the trade, right? So people can end up seeing. By the way, the conclusion of, well, I told you which two you can sell. So which do you sell? And the answer is you need to find that sweet spot that has the most premium that you're going to end up collecting and the highest volatility for that premium that you're selling. And then you're going to want to hedge it with lower volatility. You're going to want to buy lower volatility for it. You don't mind if you pay a little bit for that lower volatility. Like, for example, in the Kevlar, in the road trip trade, in the M3s, okay, or any John Lux type of butterfly structures, that upper put or call that you end up buying at the top, it has a pretty low volatility. Yeah, you're going to pay more money for it in terms of the extrinsic value, but it has a much lower IV, and that ends up helping to hedge. So the Jeep, the Weirdor, all of our trades, and that's why I wanted to end up using this one. Paul and I talked about it as it is a structure. Okay, I didn't want to use the Kevlar because I've done a bunch of things to the Kevlar to help protect against the very risk that was in the Jeep. Okay, so the Jeep had more risk in it if we ended up moving down. And so as Paul and I discussed, we thought that it was probably the most pertinent example and gave us the best teaching opportunity. Is that fair, Paul? Anything else you'd add to that as a primer?
No, I think that's perfect.
Okay.
And I had done a bunch of testing on, what I guess we ended up calling teenies. And, ended up discovering where I wanted to place them for this trade to help make them work. And then just back tested to make sure that it was going to do the job. So if you want to go through, what I did here is I logged in 2 different hedges. One was buying a put in the month that the trade is in, and then buying this was actually a 35-day put that was purchased. To see the differences, to see, even though the put was, when the event happened, it was 11 DTE on the 35 DTE initial put, that it still had a bunch of value to it. So I guess I'll just run through to the adjustment points. Basically, this trade was adjusted whenever the delta reached over 20.
Okay, and Paul, if we could, let's kind of just set the stage for those of you that don't remember what happened in 2011. We, meaning the United States of America, was about to default on our debt because the idiots in Washington couldn't decide whether or not to end up raising the debt ceiling, and they were playing, chicken with our livelihood. And the market said, they blew them off, and they said, oh, they're just politicians being politicians. And then when it got to the edge of the edge of the cliff there, we said, uh-oh, and the markets went haywire. Okay, so that was the event, because when we talk about hedging, okay, one of the things that Paul and I always talk about, is this a known event? Is it an election? Is it an earnings? Or is this an unknown event? This was a known event that everybody kind of blew off until they realized, uh-oh, it might actually happen, and then everybody got scared shitless. I just want to put everybody in the time frame of where we were, because it's we're getting ready for it. Look, and this, by the way, this is one of the biggest things, right? This is the biggest thing. Okay, you mentioned it, Paul, right? You said the biggest issue were the emotions. People going back testing, they were like, oh yeah, well I read something about that. Okay, I don't know what it was like trading. When you were sitting, okay, in the pilot seat, okay, and you had control over this thing, and it was your money, your livelihood, and your life on the line. You thought about it a lot different than, well, when it gets to 20 delta, I'm just going to do this adjustment. Yeah, try to do it in real life. What ends up happening is it becomes very, very difficult.
Well, that's true, because the big bugaboo is, this, we've gone down, balls have gone up, these puts have become expensive, and your first emotion is, oh, I don't want to pay that much for it. I did learn from trading this. You just, for me, I just pay up. It hurts, but what the alternative is it hurts worse. So we, on this day, at the end of the day, it was hit 22 delta. So basically, what I do is I buy puts to protect it, because I'm looking. And this, well, we're talking about the trade and not the hedging. But basically, this is, I'm putting on hedges, right? And I'm taking some risk off the table. But if you look what I'm hedging Vega. That's my goal. And the market's running down.
It was Vega that hurt the most on here. Yeah. Okay, Paul's speaking from experience.
Mm-hmm. So let's go. That was Wednesday. Well, let's go back and take a look at the chart. So the trade was put on here, and that was the first adjustment. It's starting to get a little ugly. And then I believe there was one more adjustment on the second, which was here. And if I do this, so it again went below the 20 delta. So basically did the same thing. And just, buying more hedges. and then I believe it was on the 8th, right, was the bottom. So by buying those two, basically hedging the position with using adjustments, this is what the trade looked like. Here. Now, I had typically at that point I was doing the 60-day hedge. So I would buy, I put in one put. In the beginning I was doing 2 puts. But basically you look at your what you collect for premium and kind of make a judgment on how much of that you want to spend in the insurance. So in the beginning, this trade brought in like $1,300. So excuse me. I spent 90 cents on this put here, which ended up 1,500%. So it made a profit of $13.55. So it was actually, the trade managed itself very well, but this does 2 things. It helps the P&L at the end, with this $1,300. But as you're going along with the trade, as the vols are going up, this is making some money to help your P&L in the interim to keep from getting too low. Now, if we go to the 35-day hedge, that was also bought. This was bought for $1. It's now worth $34. So in this particular trade, for me, it was worth, spending the money for the insurance policy, never needing it, to have this protection, because, we had this huge down move, but it could get worse. So, this is more of the big tail risk hedge that I would keep on the trade.
Now, Paul, one of the things, the setup going into this is that the implied volatilities weren't that high.
Correct.
And also the steepness of the skew back in 2011 isn't nearly what we see being more normal as in 2016. So it was a much more efficient hedge to simply buy those teenies back then. What's happened after 2011, some of the flash crash, some of the things, is that they've gotten to end up being steeper, especially with the computer algorithmic trading on it, is that they've seen the same thing that we've seen is, these things paid off nicely. So it's almost this constant battle. We used to talk, Paul, when we started, or when you started, because I started a bunch of years before you. But in 2000, when I started, we would talk about what it would be like when the floors were much more active. Okay, as things got to end up trading more and more after 2008, so many things became more electronic, more algorithmic trading. And what ends up happening is that the computers are now determining what those skews look like. The computers are determining them in the sense that as money comes in, you have to take a look and seeing what makes the most sense. So putting on a blind hedge without looking at, the price of it. When I went through those insurance examples, you could say, yep, I got everything to doing it. But what happens if the insurance is twice as expensive? You start to end up tweaking, saying, well, maybe I don't need this much coverage here, or if I go to a different provider, you start looking at ways to be able to end up lowering that cost. And so while teenies are nice for a trade like the Jeep, by the way, which has a much, much, much further back set of strikes. When you take a look at Kevlar, Road Trip, M3s, things like that, they all have much closer to the money strikes. So, buying a teeny, wouldn't end up working as well nearly it would work, but it would be more expensive. It would be a bigger drag, and the percentage or the size that you'd have to trade it to protect, say, a road trip trade, would end up being a lot greater. So this is definitely a case where we wanted to end up showing you a difficult environment, how we got killed in Vega, and what a simple hedge ended up working like with the Jeep. Okay.
Plus, and I'd like to add that, when I changed, there's been a lot of people that have traded this structure. This is definitely not mine. Just the way it's adjusted. Everybody calls things different names, and this most of the time is just an adjustment strategy that is different. And basically, my adjustments to the downside were my new hedges put on. So, the teenies become the black swan events. So you don't rely on them to help manage the trade. In fact, I never put them in with the trade. I always traded the trade separately from having those long puts on, so that I was managing it properly.
That is so important. That was something that I ended up learning from Steve Rashes. Okay, Steve Rashes is one of the first 15 employees from Thinkorswim. And he ended up telling me, carve out all your teenies. He says, you're not managing to them. They're going to end up affecting the way you think about your Greeks. Manage everything on your position, not on your, your teeny insurance. And so it's something that I end up doing, and I think that, Paul, as you end up mentioning, I think it's a great practice, and everybody should do it. You should take your hedge out, and you should end up reviewing your hedge separately.
Right.
Okay. Some of the other questions that I get asked all the time, Paul, and I know you get asked this all the time, is when do I take it off? Do you want to hit that one first, or you want me to?
You can. You know what my
No, go ahead. Just say it. That's why I want you to go first.
You don't take it off.
You don't take it off.
The ultimate, the best scenario is you have it on, it makes a bunch of money, protects the trade, and you take it off for a loss, because that means the trade the market's gone back, and you're able to make money, and you've made your money in the trade. My opinion of those, you're not putting these hedges, especially these, you're not doing these to make money with. If your plan is to make money with it, just buy the puts and wait for it to pay off.
Right.
The idea is to protect your portfolio, and it does two things in the trade. It helps alleviate the pain from your P&L, and it also can keep, once the market's moving hard, like down here, from the start of the day that you're in pretty good shape, and you're not forced on this day, with a 49-point down move in the rut, that you're going to have to adjust in the middle of that battle, because you will pay up for whatever you have to do to fix the trade. It's too late at this point.
Did everybody hear what Paul said? That was probably one of the most important things, okay, that you can learn about hedging. Okay. The true purpose of the hedge is so that you do not have to end up adjusting in the middle of, a firestorm, right? When the market is dropping, okay, like a ton of bricks, okay, where it's just, price is just totally collapsing. You go to end up adjusting during that time, and you are going to get killed, okay? By having a hedge on, okay, if you can end up waiting and then end up going and readjusting your position later, okay, because you didn't have the same risk that everybody else had on, that is enormous. I'm going to end up making a couple of points about the Kevlar. What I had done in the Kevlar from a hedging perspective is that I kind of built a hedge into the Kevlar for up to, I would consider it to be, maybe an 8 to 10% drop. We have an 8 to 10% drop, and I don't need to end up doing anything. So as long as we don't gap through my range, I can end up sitting and I can wait, Okay, and that is one of the biggest advantages of having some type of hedge or a trade that has a flatter T plus zero profile, is that you can end up waiting. That is so, so important. When do you take it off? Well, you have a couple of choices. Okay, if you have great timing, and I work with a couple of professional money managers that do have great timing. When those dollar puts, okay, go up, they sell them for $50 and they keep their position because they know there's a strong chance of being able to bounce, and they've already, eliminated, by taking their profits, they've already eliminated whatever it might end up being, 50, 70% of their potential risk anyway. Very valid way to end up doing it. I don't know if we have any Kevlar subscribers, on the call, but the other way to end up doing it is exactly the way we handled the January pullback of this year. If you remember, at the end of the year, we ended up having we were starting a sell-off in the beginning of January. We had a pretty harsh sell-off. Well, what ended up happening is that the markets came down, and this is how, one of the things Paul and I have talked about is, one of the ways I've taken emotion completely out of, trading, the Kevlar, was that if we're down 5% and your position is already, say, down 10% and you're at the edge of the cliff looking at a complete disaster, there's no way with that set of risk and, risk and emotions that you're going to be able to end up handling and making good decisions with that much fear. Whereas if you have a trade where if the market's down 10% and I'm up 5% and my cliff isn't for another, 50 points, I'm sitting there, I'm pretty comfortable, right? I'm thinking about how do I end up picking people off, not how do I survive to trade another day. Right? So your whole mindset becomes very, very different. Why? Because you're hedged properly. Okay, and so having a hedge put onto a trade that ends up needing it, like every trade needs a hedge. I can tell you, where does my Kevlar need a hedge? If we have a huge gap down, we have an environment, if you think about something like happened with 9/11 where the markets were closed for nearly a week and then they opened down slightly. But what happens if they open down 20%? I would be in a lot of trouble. Then I would be sitting in that same fear. That's why from an institutional point of view, the thing is I have an institutional tail risk hedge on it. So you need to end up trading with wherever you're going to end up being comfortable for. And you need to build, your hedge, just like this. This was a tail risk hedge with a low implied volatility and not too steep of a put skew. When you have that environment, going and buying a single put's an easy hedge. It's the best one you can end up doing. Now, what do you do when IV's low and put skew is very, very steep? That well below the money put that Paul ended up buying, and maybe when he bought it, it had a 15 or an 18 IV on it. What do you do if it at the money is a 12 IV and the put that you want to buy for your teeny is a 40 IV? That means that if implied volatility goes up to 40 and your put becomes at the money, you're not going to make any money on Vega. If your trade has a ton of Vega risk, like a lot of butterflies do and a lot of condors and Jeeps and Weirdors do, that's not going to help you. Do you need to end up only protecting, say, down 10% because you're not too worried that the market's going to end up dropping more than that? If you have a really, really low IV and a very steep put skew, that means that if I buy a very wide put vertical, the put that I buy near the money is going to have a low IV, and the IV is going to end up being very high of the one that I sold. Again, I'm selling high, buying low. I like that idea. But is that going to end up helping me if IV spikes? Nope. For something like that, I'm going to have to end up doing something that's going to be being long Vega and getting longer Vega as we go down. Something like a calendar spread or a diagonal. Maybe I buy a few more in the back month, and so that I can. So you're going to have to know, and this is probably the single biggest thing, Paul. And over the years, I know it's the one that I've learned the most though out of the last 10 years, is to learn when to use what hedging technique in which environment. That's a very difficult question.
That's correct. We've got a couple of questions here.
Okay.
I was looking at. Somebody asked about the George asked about the pros and cons of the Jeep trade versus the M3 strategy. I think it's different.
Can I do this one because it's got vehicles in it, and I love answering questions with vehicles.
Okay.
I've owned a Jeep Wrangler. I also own a 328i convertible. I've never owned a BMW M3, so I can't answer the question. They're different trades is the answer.
That's correct. I don't think that one's better than the other. With the one caveat is that I am currently not trading the Jeep, and I am trading, below the money, but a similar setup to John's trades. It's
Paul,
kind of completely different, but
Paul,
basically.
Let me modify the question a little bit.
Okay.
Tell them where you put your money where your mouth is. Tell them what you currently have on right now.
Nothing.
Okay.
Well,
and why?
No,
and
no,
why?
Wait
why?
a minute. I do have one thing on.
You're afraid of the election.
I am a subscriber to the Kevlar, so that's the only thing that I've left on. But yes, I'm worried about the elections and my risk management right now because of the style of trading I do. It's best for me to just go to cash and wait for it to blow over. I did that. I did that in Brexit as well.
When you have a known event coming up, okay, people don't think about cash. I gave the example of, one of my dear friends from college, Joe Spinetti. It's a great guy, but the problem is he had some challenges with his weight, and many times he would end up going and being over 300 pounds. And we were out one time, and somebody said to Joe, Joe, listen, you really need to end up getting in shape. To which Joe responded, looking him square in the eye, saying, round is a shape. Okay, cash is a position. Okay, when you're going into Brexit, it's fine to end up, so what? So you lost what? 4 trading days or 3 trading days? The opportunity you have to end up going in when the market ends up moving dramatically is so great. The chances of you being able to stop a potential large loss if you end up having a move are so great that it is a good strategy, okay, for something that has like Paul trades shorter term, structures. And the short-term structures, there's no way to recover once they end up moving out. Okay, with the Kevlar, the way I end up having it structured right now, if we move 100 points, wake me up. Okay, I was looking before, Paul, you would end up laughing. I'm on a $50,000 account. My P&L is $60 now, but before it was 3 cents. Okay, and when I went to take a look, I stopped looking because it's so flat. I think that when you take a look at your positions, you have to end up taking a look at, John Locke's position. Okay, I'll give you one example about this because I've had to answer this question, probably about 100 times. Okay, in my Kevlar, versus a John Locke M3, many people have spent a huge amount of time trying to improve upon the theta that they end up paying for John's long call. He'll end up telling you that it needs to be, an 80 or a 90 delta call. People have looked and say, well, I can buy, a 99 delta call, but it costs too much money. So I'm going to start to end up using weeklies, and I'm going to end up doing rolls. And they look at me and they say, well, I'm not trading normal. To which I respond, normal for who? This is normal for me. It's maybe not normal for you. But I'll end up a lot of times, if I'm using, because I have 2 entry structures, right? It's a bimodal trade where I'll go in 2 different ways. But if I'm going to be buying a long call, many times, I'll buy a 65 or 70 delta call. Sometimes it'll end up being more in the money. And they're like, how could I be doing that? Well, I'm not worried about my delta. I can control my delta. Trade risk management. What I'm worried about is I'm protecting against Vega, number 1, and Gamma. And so how you end up structuring your hedge has to be very dependent. If I was going to end up hedging an M3 or a Jeep, I'd have to worry about my Vega at a much earlier point than I would have to end up worrying about hedging my Kevlar. So again, when you take a look at it, if it's an M3 versus a Kevlar, an M3 will end up having slightly better Vega components. You'll get hurt more on Vega on a Jeep as you end up going down. Both of them will be relatively flat in market pullbacks. what will end up happening is that they both have a cliff, meaning that if you go out the back end of the Jeep or out the back end of the Butterfly in an M3, you have to end up worrying about the rate at which you'll end up losing money. In a normal skew environment, meaning that we were let's say slightly steep because IVs were low. As we go down, as IVs get higher, what will end up happening is that the Jeep will end up protecting you longer on a normal pullback, but once you end up getting to that precipice where you start to end up going over the cliff, it's going to lose money at a more rapid rate. So it'll protect you more in the beginning, where if you end up getting a pullback, okay, and it gets through, the decline in the value will be slower in the M3. Okay, that's the type of analysis you have to end up taking a look at as you're saying, here's where my trades are. Okay, and here's what I'm trying to end up hedging. So other questions?
Yeah. Let's see. Well, I just wanted to add one more thing to the trade. First is the M3. The reason, my personal reason for switching trade ideas is more the capital efficiency. The Jeep is very capital intensive.
It is.
And I felt that after trading it for years, I went to I was doing butterflies as well, and I just liked the adjustment patterns and the profitability in a butterfly. I trade a trade that I open and close once a week. So in the 60 days that I'm in a Jeep trade, which has an average of about $500 to $600 worth of profit, average over the several years, I can make that every week or two doing a trade that has the same amount of risk on it. So for me, I like lowering my risk and increasing my profit.
Yeah, and I found the same thing. What I found was that, and if you think about where those short strikes are, okay, by using a butterfly structure that has a peak below the money versus having two separate peaks, like at the tops of the Jeep, okay, the top of the back of the roof and top of the windshield, you're trying to collect it was a good general trade, but trying to pinpoint where you're getting that maximum efficiency of highest IV and highest extrinsic value that you're collecting. It's better to end up putting that at a single point than spreading it out. You do have to end up adjusting them, okay, but they tend to end up being more, as Paul, you said, it's more capital efficient that way.
Yeah. Now, there was a question on, let's see, when the volatility is already high, can you comment on selling at the money calls or even slightly in the money calls versus buying puts as a hedge? The risk with doing that is that if you go back and take a look in historical data on the SPX, you'll find that the largest up moves are in a bear market. So it becomes very risky to sell at the money calls when the market's, because I'm making the assumption if the volatilities are already high, that means we've already run down. So your risk of a bounce becomes far greater when you've already moved down. So you could really get hurt on being short calls at that point.
Yeah, I'm going to end up issuing you the same challenge that I end up, and that's to everybody here, same challenge that Paul, you and I spoke about that we issued to Evelyn many years ago. We were in a situation similar where we are right now. We weren't sure what's going to happen in the market. They were afraid about, what happens if the market ends up moving down. And the concept came up, well, can you sell calls against it? The answer is you can. IVs are higher. You're going to collect more money. Not only are IVs higher, but put skews are flatter, which means that the calls above the money are even more expensive than the puts below the money on average, because we have a much flatter put skew. But there's a reason for that. It's not like it's free. Okay, go and take a look at the 20 largest up days in the Russell or in the S&P. going back to pretty much as far as you want. What we ended up doing is that I think the exact challenge we ended up issuing to Evelyn was that over the last 10 years, go and find, the 20 largest up days. And she came back that 20 out of 20 were in the middle of bear markets. Okay. Does anybody know? Here, a trivia question. How much did the S&P bounce on the Tuesday after Black Monday in 1987? We were down 23% on Black Monday. Do you know how much we bounced? Anybody? I'm not looking at things here. Do we have any responses, Paul?
Nope, not yet.
Very good. Tom, you're exactly right. Okay, 15%. So think about this. How well would have selling a slightly above the money call worked if you did it at the end of the day on Black Monday? You would have lost as much money on the Tuesday after that you lost on Monday. So no, it's not a good strategy most of the time. When you take a look at it, your hedge has to end up being, if it doesn't work, how much is it going to hurt me? Okay, people tend to end up taking a look and say, well, I'm going to collect this data, and if the market goes through this exact path, here's the way I'm going to go and make money. You need to end up getting the directions back to Fantasyland that I showed before, because it's never going to go the way you think it's going to end up going. Matter of fact, it's usually going to go the way that you're going to end up losing the most money. Okay, right? At least that's what happens to Paul and I.
Jim, do you have your live ball up to show the
I do.
skew?
I do.
Because the next question is elaborating on tail risk hedge ideas. And unfortunately, tail risk can be a moving target.
Okay. And if, Tom, if you're the host, could you give me the ball or whoever? So you guys can
sure.
I think I can do that.
Okay, you did. Thank you. Okay. And let me just share.
And I'll kind of show my thinking in the reason that tail risk hedge is different depending upon what's going on in the market.
Okay. Here's what we're looking at. I can look at every single expiration. What I chose to look at is just the monthly November, December, and January. Okay, but if you wanted to, it gets crazy. Okay, now here's what I want you to end up taking a look at. The green line, right? This brighter green line here at the bottom is the January monthly expiration. The center orange, I guess more of a yellow line, is the Decembers, and this more, army green type of color is the Novembers. So what ends up happening is that when you go very far below the money, very far below the money, the put skews get very steep. Okay, what you can see here is that Paul and I know that these lines are straight. Or at least normally they're straight. If you take a look at this, there's some curvature to them, right? You see how this area right in here is kind of bowed out a little bit. It's a little bit higher than being a straight line. That's election risk fear. Okay, that's why a lot of you are not making the money that you think you should be making, because what's happening is that this is normally the area where I told you, you get the peak of selling the highest implied volatility and collecting the whole amount of money. Now, since we're short those, we want that to be nice and flat, so we're making money. But right now, we're not making as much money as that we'd want to. Why? Because these volatilities are being I'm going to call it, they're very popular right now. They're being bought by a lot of institutional money managers. What happens if, and I ended up writing a trade planning note to the Kevlar guys last night because I didn't plan on doing anything until at least Tuesday. And that is, one of the things that's going on is that there's election risk. Now, there's election risk. Okay, right now the polls kind of end up saying, okay, if the Democrats win the presidency, but what Wall Street fears is what happens if they win the presidency and the House and the Senate. If they end up doing that and you have all three parties and end up having one thing, it tends to end up being our policies tends not to be centrist, but they tend to end up going towards the way that the parties have the majority in. So that's usually not a good thing for Wall Street, right? I'm not a political guy. I don't care about stuff. I care about how it affects the markets. Whereas if the Democrats win the presidency, but if the Republicans control the Congress and the Senate, they would end up pretty much doing what they always do, which is nothing. Okay, it's good when for the markets usually when the the government doesn't do anything. I forgot who was it. Was it Ronald Reagan who said, I forgot the number of words. It was the 6 or 8 scariest words in the English language. I'm from the government and I'm here to help. No, it doesn't happen. I think the greatest irony of it all is that the single biggest, I don't know if this is still true, but the single biggest federal building, remember what Reagan tried to do? He tried to cut spending. The single biggest federal building, in the country is actually named the Ronald Reagan building. But you can end up seeing here that how we have this bowed area where it's a little bit higher. Now, here's one of the things that when you build a hedge, and I have, Paul and I probably have about 6 of them that we've built out and we've used. You want to take advantage. Let me give you one simple thing that you want to take advantage of. Look at what happens over time. Look at the bright green line to the yellow to the khaki green line. Look at what happens down here. What happens is that the implied volatilities are going to go up, as time goes by. And by the way, I just picked these strikes. You'd pick the strikes that you're actually thinking about using, or going to be in the life of your trade, meaning if you use 60 days, you're going to want to see how it ends up maybe moving every week. And you can take a look at what happens, as Paul calls this, the belly of the curve, right? The puts and the calls slightly above the money. They go, and even at the money, they'll go down over time. The rate at which things decay depends on this. So having a hedge, for example, that is a put spread. I'm simply buying a call a put spread. A put vertical. I would I'd buy a put closer to the money, and I'd sell one over here. Well, if I buy this one here, look at what's happening with the one that I'm buying. Right, the IVs are going to drop. That's not good for my long call. Or my long put, or my long option. What's going to happen down here where I sell this one over here, well below the money? My IVs are going to be going up. Well, if I'm short, I don't want IVs to go up. So is a put vertical a good hedge? Well, it depends. What happens if we're already super steep, on this thing? IVs are very low, and I'm buying a low IV, and they're already very steep, and this one's very high. Well, then that's a good hedge. What happens if IVs are higher and these skews are flatter? Well, then time is going to end up hurting me, and it's a terrible way to hedge. So one of the things, and this is, Paul and I can do more of these classes, or we can even put them together in a series of classes for you. Like, for example, buying a put vertical. Great downside hedge for a portfolio, a normal, I need to end up, if it's going down, I want to be able to offset some of my risk. A great hedge if I'm hedging, let's say, an S&P 500-like portfolio, and IVs are very, very low and put skews are very steep, right? One of the best hedges you can put out there. So, we've given you now 2 different types of hedges. To end up doing this thing properly, we'd have to end up realizing that we'd have to go through dozens of different scenarios and show you which hedge to end up using when, and we just can't do that in an hour. And that's where we are right now. We've already used an hour of time.
Well, one of the things that, I want to show this, because the comment on the tail risk where, it's defining the tail risk because when I look at the bump in the curve that we have where everybody's interested in buying the puts, those are guys that are smarter than me that have made the educated guess that how far down the market's going to go. Correct. And that's where they buy their protection. So, if that's the case, because I've unfortunately witnessed buying, a two delta teeny, and the market goes down, and have the teeny not go up in value at all. And when I look back at the structure, in hindsight, I saw that everybody was buying a 5%. a put 5% below the money. So they were all expecting it to go down 5%, and that's what they were protecting for, and I'm protecting for a 10% down move. So, you have to kind of look and try and guess where you think the tail risk needs to be effective.
Okay. It's really, really important, and I get so many questions around this. Tom's put together a URL. We're thinking about, Paul and I have been going through this for a while. We're thinking about going through an entire hedging class. The URL, Paul, I'm just going to end up sharing it. The URL is, the simple one that we always use, cdurl.us/hedge. And all it is if you're interested, okay, if Paul and I put together a class, if you'd end up just giving us your name and email, this way when we do something, we can end up sending you the information. Again, okay, that URL is, let me put it up here. Tom, would you put it in the chat for everybody?
Already did, Jim.
Okay, thank you. Okay, just put in your name, your number, and what we'll do is and what we would end up doing is that, because this is what Paul and I have done. We've gone through and we've looked at a whole bunch of different types of trades and hedges and what ends up working. For those of you that never heard me speak about this before, it must have been about a 3.5-year period, I worked with a company called EAB. Okay, I did a lot of consulting work for them. And what we ended up doing is that we built out hedges on portfolios for institutional clients. And first thing we would end up doing is, remember, they were Delta One investors. Most of the stuff would be, S&P lookalikes. So we ended up building different hedges for those. And we went through a ton of quantitative work. Here's the problem with backtesting, and this is what ends up happening when Paul and I do this all the time. We go to a point where the loss ends up looking the worst, and then we go and we'll open up Option View or open up Option Net Explorer, and we'll take a look and saying, well, what happens if it moved down another 5 or 10%? Okay, what was our real risk? What happens if you end up being? Take a look at this, Paul. Take a look in what do our Vegas look like? What happens if we end up going down another 4%, but volatility goes up another 10% because people get afraid of whatever? Okay. What happens if the put skews flatten? What happens if they get steeper? So you have to end up taking a look at this. And the simple concept of going in there with a one-size-fits-all, oh, the market's gone down, let me go and buy puts. Oh, the market's gone down, let me go and sell calls, will end up killing you. Okay, so all we want to be able to end up doing is kind of end up giving you the tools so that you can end up using the correct hedges given the current market situation. That's very, very important. I'm not trying to guess that something's going to happen. I'm not saying the market's going to go down another 10%. I'm not saying volatility is going to go up. All I'm saying is, what if? Okay, what if? And the what if says, where's my loss going to be? Because it is so many times, okay, that we have scars from we didn't ask that what if question. So by being able to end up putting together, kind of a set of guidelines on what hedges to use when, we think it would be really, really helpful for the community. So if you're interested, write out, your name and your email, and when we get something that's more presentable in a class type format, we'll end up letting you guys know. Paul, anything else? I know we're over our time.
Nope, I think that's it.
Tom, anything else?
I think that'll do it, Jim.
Okay, I hope this was a good introduction to hedging for you guys. It at least gave you some of the tools so you know what you're looking at. Good luck, and we'll talk to you soon.
Have a good day.
Jim, Paul.
Okay, thanks. Bye now.